Hello, good afternoon, everyone. My name is Reginald from Schroders. Thank you very much for being here, and Happy New Year. As our very enthusiastic MC just said just now, we are very keen on Asia, and you can see from the slide, we are talking about opportunities that are available to us to invest in 2026. So good afternoon again. Let's start with the first slide, which is always to look back 1 year and think about what happened in 2025. As we remember, a lot of it was about Trump. It still is about Trump to this day, unfortunately. But we remember very clearly what happened in April, which was Liberation Day, tariffs, the U-turns after 90 days, etc., etc. Lots of disruption, if you want to call it that. Despite all that, markets survived and actually did pretty well in 2025. Something to think about when we go through the slides. So that's the first point. Second thing is that Asia actually did quite well overall. If you remember, the GDP growth for China was 5% in 2024, and it also continued 2025 at 5%. So generally, Asia did well. And if you also turn your minds back, 1 year ago, it was the DeepSeek moment when it was unveiled to the world, and markets have taken that on with a vengeance. The snowball has continued to roll. It's all about AI nowadays in so many ways. So AI enthusiasm also helped markets, even if it was seen as a disruptive force. It's also been embraced and used in industry. And AI was also very, very helpful for Asian markets, especially Korea and Taiwan. So that's the backdrop, what happened last year. Now, let's look forward and think about how growth is going forward. We have some charts here on the left-hand side. It's world GDP. On the right-hand side, it's world inflation. We remember what happened 5-6 years ago with COVID and then the Russian invasion of Ukraine 2 years later. We are past that now. Growth has come down to a comfortable level. So if you look on the left-hand side of this page, we expect global growth to be 2.6% for the next 2 years going forward, which is fine. We want it to be stable. We don't want it to be a yo-yo up and down. So 2.6% is a very, very acceptable number. But more importantly, look on the right-hand side, you see inflation coming down. That's global inflation ticking down, which is good because you are less worried about prices, you are less worried about interest rates. And as we know, interest rates drive movements in equity markets, in bond markets. So it's, I don't know if you want to call it a Goldilocks scenario, but it almost seems like we could be somewhere there. So that's not such a bad thing for markets, right? Let's also talk about the US labor market. If you look on the left-hand side, there's a purple line. That is how the labor market did in the US. It tanked, it collapsed over much of 2025 simply because employers were firing and also not hiring. And the labor market worsened very, very sharply until you see that tick up in the last couple of months. And why is that so? Because generally speaking, you heard of the term the taco trade. Trump always chickens out. So that's what essentially happened. Everyone got used to Trump. Everyone got immune to all the big announcements from Trump, which happened. He didn't follow through. And so it's like, okay, we should start business again. Employers got tired of not hiring because they wanted to see their business grow. So we've seen that happen in the last couple of months. So generally speaking, the US labor market has done pretty well. On the right-hand side is just a chart to show you that over the long term, actually, the US unemployment rate is pretty acceptable today compared to history. We were talking just now about Liberation Day. So the tariffs at the beginning of the year, before Liberation Day, was about 5%. And then it went up to 44% at the peak. And then as you can see, it's drifted down and drifted down. Yes, 20% is still higher than 5%. It's true, but if you look on the right-hand side, if you can't sell to the US because of tariffs, what do? You sell elsewhere, correct? Because you still need to continue. You produce things, you have to sell it to somebody. So that's what we see on the right-hand side, what China has been doing If they can't sell to the US, which is the green line, that's the share of exports, it's drifted down very clearly. So you sell elsewhere. You sell within Asia, that's the light blue line, and then the dark blue line, which is to Europe. So that's just common sense. Trump doesn't have a monopoly on the world. If we can't sell to you, we'll find someone else to sell to. And that's exactly what has happened. And all this points to why we feel that there is the opportunity out there today for Asian markets. It actually, you might be surprised to learn that actually the Chinese equity market did very well last year. It's easy to forget that because there's always a lot of noise about China. And you may have even heard the past couple of days, there's a very well-known stock called 𝐓𝐡𝐞, which collapsed 20%, simply because they say that, the Chinese authorities say that this particular company is breaking all kinds of antitrust rules. So you get a bit worried when you think about all these things happening in China. But generally speaking, Chinese authorities say, I'm not worried about what the US is doing about tariffs. I can find my way around it. I've been around for 2,000 years, 5,000 years. You're going to be gone in the next 3 years. Things like that, they find a way around it, and that's what they've done. And so that's why we think that growth remains very strong, very stable in Asia. Those are the numbers on the left-hand side, Asian GDP growth. That's the two lines at the bottom. And then, of course, when you have a weak US dollar, which is what we've seen over the last 12 months, 12 months ago, the US Sing exchange rate was 1.37. We pay 1.37 Sing for every $1. Today we pay about 128, 129. What that means is that the US dollar has weakened, not just against the Sing, but against every currency in the world, except one notable example of obviously everyone knows, which is Japan. And that's fine for us because we love going to Japan as tourists. But the US dollar has weakened because of all the issues with Trump, the fact that they cannot trust his policies, and the fact that the US economy is holding up okay, but there's still all these concerns about inflation and all the issues that we have there with Trump. So what you see in the middle chart is the blue line is the US, sorry, let me look at that, is the US 10-year Treasury yield reversed. And then the green line is Asian markets performing. They generally move in the same direction, as you can see. So that's what we expect to continue going into 2026. US yields are likely to stay stable, and and Asian markets are going to continue to hold up well. And also very importantly to point out to valuations, even if Asian markets have done well in 2025, the green line and the blue line are Asian and China markets. The black line is MSCI World. You can see that in terms of valuations, we are still cheaper compared to the rest of the world. So you have so many things in favor of Asian equities in 2026. I already mentioned the macro backdrop, which is the GDP growth on the left-hand side. On the right-hand side, it shows you inflation across Asian markets, specific countries such as China, India, Malaysia, Philippines, Singapore, etc. Generally, all these lines, all these dots, what we're trying to express here is that inflation is within expectations or even better than expectations. So we have no concerns that prices are out of control in this part of the world. And with all that in mind, that means that Asian central banks have the room to cut interest rates. And that's what we've actually seen. On the left-hand side, all the cuts that have already happened since the peak by all the various central banks across the region. From the very top, you have the Philippines having cut 1.75%, another 25 in the fourth quarter of last year, and more cuts, which we expect in 2026, which is in blue, 50 basis points. So those are all the cuts in interest rates by Asian central banks across the region, which shows you that all that is possible despite the fact that because there is no inflation out here, because the dollar is so weak, and because we want to support our economies in the region. I showed you this chart previously, but this is a little bit of the history of it, going all the way back 20 years. And what you see is that when interest rates, when the dollar weakens, which is the green line, when the dollar weakens, Asian markets do well. Why is that? When the dollar weakens, it means that investors want to move away from a safe haven currency, which is the US dollar. You realize that today everyone has moved away from the dollar. It has weakened, as I said. You also know one thing which I haven't mentioned before, which is that gold is at all-time highs. Why do people run to gold? When there's a lot of global uncertainty in the world today, geopolitics, Trump, people run to gold. And that's exactly what has happened. The dollar weakens, Asian currencies strengthen, Asian assets do well. This is a chart. It's almost empirical proof that this is what happens over time. So, what are the themes that we see across Asia today? We used to think of Asia being a manufacturing hub of cheap things, t-shirts, shoes, toys, plastic things. And yes, we still have some of that across the region. We still do that, but I think we are much more than that today. For example, we know that the best-selling EV, electric vehicle in the world today is no longer Tesla, it is BYD. And for us in Singapore, we have seen BYD everywhere, as well as so many other Chinese makes. But aside from that, everything that's related to tech, in AI, and also EVs actually, are manufactured. We are global leaders in this part of the world. So on the right-hand side, you'll see several industries, several sectors where we do well. Batteries, capacitors, photovoltaics, etc. And then the flags of the various countries. And you see China, India, Korea in there. And Australia actually also. So this shows you that we are much more than manufacturing cheap t-shirts. We have obviously scaled up very aggressively on tech. And so we have that opportunity also to benefit from AI. And as I just said, the tech spending on AI is the largest for Korea and Taiwan. We know that some of these Korean companies, the Taiwanese companies are aggressively expanding, not just in this part of the world, but also within the US, where they want to take advantage of the presence in the local market there to avoid the tariffs, etc. So there are ways in which our tech companies in Asia are getting around this issue, and that's how they are also growing aggressively around the world. And our exposure to AI is not just in the the producers of the chips, the wafers. It is to the companies that will also take advantage of AI to be able to improve their performance and their results. So AI, I think it's inevitable, and I think it's also not arguable. It will continue to take up much greater space, not just in the tech industry, but across the board. China, we think of China as having all these issues because of Trump. I think that's the enduring image, unfortunately, that because of Trump and all the tariffs from the US on China and the fact that he continues to bang on about it, that China has a problem with tariffs. As I said previously, they found a way around it. They sell to other countries in the world, and it's proven just fine. And just to look at some examples here, what China has been doing over the past couple of years, they have been preparing. And as for the companies listed in China, you have their earnings, which is on the left-hand side, their earnings improving aggressively from 22 onwards for the past couple of years. Earnings have been doing well, valuations have been good. Second point is that when the Chinese economy was a bit unstable for the last couple of years, the government has been cutting interest rates aggressively. So that's the middle chart. You can see yields coming down a lot. So that helps to support industry, and at the same time, it encourages investors to move away into more, if you want to call it that, more risky assets. So that's why they've chosen to invest in Chinese equities, which did very well last year, and as we all know, one big thing that Chinese retail investors have actually been buying is gold. So there's been a lot of money that's being shifted away to so many asset classes away from cash in China. And then finally, what the Chinese authorities also did last year was to come up with this idea of anti-involution. It's just a simple way, using a complicated word, for the government to tell companies in China to stop killing each other, stop cutting prices aggressively, stop over-expanding so that it becomes more rational competition. So that's what they've done, and that's actually helped industry and helped growth in China. We also know that there are lots of things happening from a fiscal perspective. So governments are looking to spend more to support their economies, that's one. And there's also a structural push for stock markets to improve, because we've also seen over the years how the US market has actually dominated global equities for many years now. It's fair that they've done well. It's been a good market. They've had strong earnings, but we feel that the tide has turned. It's also shifting now to Asia. So the reforms in many parts of Asia, Korea, Japan, China, Taiwan, etc., to improve their returns on equity, to ask companies to do more share buybacks, to pay out more in the dividends. That is a very real thing happening across the region. And for us in Singapore also, I'm sure you read about the program by the Monetary Authority of Singapore, EQDP, the Equity Market Development Program, where they have handed out, or are in the process of handing out 5 billion Singapore dollars to fund managers to invest in Singapore equities. The Singapore market did very well last year, more than 20%, as we all know, so that's fantastic. We feel that it will continue as the money is spent this year. It hasn't really been. You've got a lot of fund managers who have been given this money, and they will be putting it to use into the market this year. So you imagine how that could continue to create that excitement in Singapore equities. And what we feel also is that aside from equities, I've spoken a lot about that, Asian credits will also hold up very well. Just from the simple fact that growth remains strong here and the fact that interest rates have room to come down. Credits spreads are tight. We know that because it's been very, very popular. But we feel that it will be supported. It will remain tight due to technicals and fundamentals. Technicals because issuance hasn't been as strong as before. So the supply will not be overwhelming. So those are the bits of good news that I have to talk about. And if you recall the first slide I showed you, which was a bunch of pictures, very happy Donald Trump, etc. Let's end with this one. As we look forward to this year, what are we thinking about? Well, first of all, Trump in his second term as president, it's not 2.0, it's 2.1, because things are turning south a little bit for him. He's been very, very erratic, shall we say, and even in the past couple of weeks, you've seen ICE, which is the immigration authorities in the US, being very aggressive in the way they treat their own people or foreigners. It's not been great. He's losing ground, and he is looking to support his own economy as he heads into the midterm elections in November this year. It's a given that Trump will lose some seats. The question is how many seats. It's typical that the incumbent always loses seats. How many seats will he lose? He will try his best to make sure he retains both the upper and lower houses of Congress. And how will he do that? You know that the first thing he will do is to install a new Fed chairman who is going to listen to him, do his bidding, and cut interest rates. So we can look forward to interest rates cuts in the US. We can look forward to more of erratic Trump. And as a result, we can look forward to a weak US dollar. And like I said, weak US dollar, liquidity in Asia, strong Asian assets. That points to that Asian renaissance, which we expect to see this year, to continue to see this year, from China as well as from tech-related issues, and even from domestic support by our governments across the region. So thank you very much. Think about your portfolios. Happy investing for this year. Thank you.